Hey, Saretsky here. Welcome back to the show. As expected, the Bank of Canada slashed rates by 50 basis points. For those of you that have been following this channel for the last 7, 8, 9 years, you know the core theme of this channel has been, listen, the Canadian economy, the Canadian housing market is built up on a mountain of debt, and that there was no way you could sustainably raise interest rates at levels where basically the economy can't support these levels of interest rates. We go from 0 to 5%. You leave them at 0 for a decade. You let people basically accumulate all of this debt. And then you raise rates by 500 basis points. There is no way this is going to be sustainable. Of course, the Bank of Canada has now cut 175 basis points since the peak. They've cut them 175 basis points down to 3.25%. And they're getting closer into what they call their neutral rate, which is where they think rates are not stimulative, but they're not restrictive. And I would argue they've still got some ways to go. But again, as we've been talking about on this channel for that last number of months, this remains the core theme of this channel, which is the Bank of Canada is sacrificing the Canadian dollar. What they're implicitly doing and saying by cutting rates another 50 basis points this past week is, listen, the Canadian consumer is really struggling. The economy has too much debt, too much leverage. We need to basically help support them, bail them out, whatever you want to call it, by cutting interest rates and diverging from what's happening in the U.S. with the Federal Reserve. And so they're implicitly killing the value of the loonie as a result. And so if you look at what's happening between monetary policy between Canada and the U.S., this is the interest rate differentials are going, this is the widest divergence since 1997. So you have the Fed and the Bank of Canada going two very different paths. And so again, the result is the loonie is paying the price for that. In fact, the loonie just hit a 4.5-year low against the US dollar. And by all accounts, you have to think that things are only going to get worse from here logically. And I'll frame up exactly why I think that is. If we clip over to Tim Mackrum's comments from the Bank of Canada presser, he cites the weakening economy that we currently sit in today. So let's clip those comments right here.
Yeah, when you look at all the data, it does tilt towards a softer economic outlook, a softer outlook for GDP growth than we published in October. As I said, Q3 growth has come out weaker than we expected. It looks like Q4 is going to be a bit weaker than we projected. Add in the fact that the government has lowered their immigration targets for next year. That's likely to pull GDP growth down next year, so we're not going to get it back. So you put that together, both of those factors really signaled that a 50 basis point cut made sense.
You know, he notes the slack and the weakness in the GDP economic growth moving forward. But what we're seeing is in the jobs data as well. And we talked about this last week, the weakness in the labor market, the unemployment rising to the highest levels in nearly 8 years. And it's going to continue to get worse because we know that there are simply more people chasing fewer jobs. We've added so much new immigration into this country. There's not enough new supply of jobs for them, particularly in the private sector. Remember, as we talked about last week, over the last 5 years, nearly half of all jobs that have been added have been government jobs. And so the weakness is in the labor market. It's going to persist. So the Bank of Canada is cutting rates. But what we're seeing in the States is different economic data. This is a country that is moving in a different direction than Canada. And usually the two kind of follow the similar unison. Usually what you tend to see is the U.S. actually ends up carrying the Canadian economy. We're seeing them actually diverge today. And I think there's a multitude of reasons. I think clearly the leadership in this country is disastrous. But they are diverging in different paths. And so what you're seeing is actually the economic data in the U.S. continues to come in stronger than expected. Canada's continues to come in weaker than expected. And so what's happening is you're actually seeing the economic data in the U.S., and that's actually pushing bond yields higher. Over the last 7 days, we had a string of U.S. economic data that came in significantly stronger than expected, pushing the U.S. 10-year bond yield higher. And as a result, that also pushed the Canada 5-year bond yield higher, right? So remember, the Bank of Canada came out and cut rates by 50 basis points, a jumbo rate cut. And yet the 5-year bond yield pushed higher by 15 basis points this week. 15 basis point move in a couple of days is no small feat. And that's again because the U.S. The data is coming in stronger. They've got Trump that's coming in and saying, listen, we're going to deregulate. We're going to be a pro-growth agenda. Whether you agree with that, disagree with that is irrelevant. The market believes that. And you've got inflation data in the U.S. now starting to creep higher once again. So the question is, well, hold on a minute. Why is the U.S. Federal Reserve cutting rates? The economy really isn't bad at all. Inflation's starting to reaccelerate. And we've got a government that's coming in and saying they're going to deregulate. And this is going to be the largest economic boom of our lifetimes. Again, a lot of that is subjective. But that is the rhetoric. We know what we're getting in Trump 2.0, which is, deregulation, pro-growth sort of policies, pro-business. They just announced they're going to lower corporate tax rates to 15%. I mean, is that going to be, how does Canada remain competitive in that environment? You talk about dollars being sucked out of the Canadian economy. That's certainly not going to make things any better. And so the question is, well, why is the Fed then cutting rates? So there's a high probability here that the Fed might be done cutting rates in January. So yes, the Bank of Canada might have to actually keep going because the economy here is so weak. Housing, which is our main pillar, is weak, that they're going to be almost pinned into a corner and saying, okay, well, we kind of need to keep cutting, but gosh, the Canadian dollar keeps moving lower. And at some point, it's going to be a problem. That problem is not today, but it's probably sometime in 2025. And so what I really caution people is when we talk about housing, I've said this on my channel for many months now, is everybody keeps talking about, the Bank of Canada, they're cutting rates, housing's going to reaccelerate, variable, but it's only moving variable rate mortgages. Again, your variable rate mortgage this week just went down another 50 basis points. That's fantastic. But your fixed rates moved higher on the week, and they're still chopping around in the low to mid fours. And that might be as good as it gets, not because the Canadian economy is doing so great, but because the U.S. economy is doing better than expected, pushing bond yields higher. So I think that's really important to contextualize, again, to reemphasize that everything we've been talking about in this channel for several months continues to play out. And we have to monitor what's happening in the bond market. Again, if I am the Bank of Canada, they cited in that clip there, Tiff Macklem cites, population growth slowing. They're not really worried about inflation today. If you look at what's happening in the rental market, we've talked about this on this channel. The rental data just came out this past week. Vancouver rents, right here, down 11.6% year over year. Asking rents down nearly 12%. Toronto down 8.5%. The decline in rents is happening at the time when, we're told immigration and population growth is going to go to basically zero over the next 24 months. Assuming the federal government can finally follow through with a policy measure, we're told that population growth is basically going to slow to zero at a time when rents are already declining and the number of units that are currently under construction in the pipeline remains near all-time high levels. And so this is a market that, all else being equal, I think is relatively well supplied in the near term. In the near term, it is relatively well supplied. And that's, again, subjective to say, well, if rents went up 40% and now they're coming down 10, are we really well supplied? I think people would argue we're still in an affordability crunch, even with rents declining 10%. So someone could come to say, well, maybe we're not oversupplied enough. Maybe we need even more supply. And that supply is coming, at least in the near term, when you look at the construction pipeline. As we move further and further out, we know right now that housing starts are falling and falling rather quickly. Falling off a cliff is the word that I like to use, and that is going to sow the seeds for your next sort of housing crunch or housing shortage down the road. And that, when I say down the road, we're talking 3, 4, 5 years from now, not in the next 1 to 2 years. And so that is going to continue as you see declining rents. Again, what is the incentive to get investment dollars back into the market, aka get investors buying pre-sales that then fund those pre-sale dollars, those investment dollars, is what funds pre-construction sales and the ability for these developers to get financing. And so as an investor, you look at it and say, well, what's the outlook? Our economy is really weak. The Bank of Canada is telling us as much. And, you know, rents are declining. We're being told that population growth is over. And so what is the incentive for the investment dollars to go back into the market? So when people then ask, what is the outlook for the housing market in 2025? I say, well, it depends. It depends what markets you're looking at. The pre-construction market, I think, is going to continue to suck wind. The investor market, the demand for rental units, small dog crate condos, that looks impaired going into 2025 still, even with the Bank of Canada, again, cutting rates and probably going to continue to cut rates due to the obvious weakness that is in the Canadian economy. And again, the result of that will ultimately be a weaker Canadian dollar, and that is what we call the release valve. So we're all going to be paying the price through the exchange rate. So if you've been enjoying your vacations down south, get them in while you can, because I don't think they're going to get any more affordable in the near term. So that's kind of what I'm looking at this week. Again, another BOC jumbo rate cut, rents declining. And we're going to get a fall budget on Monday. We're going to see how bad our public finances are on Monday. And I'm not optimistic there. So I'll circle back next week with my thoughts and things that we're watching heading into the new year. So as always, hope to help. See you next week.